So your numbers coming out looking like a pretty hefty beat. Really, what area of the business propelled these figures higher than what was expected by analysts?
Hi, good morning, Dani, and very nice to be on the show. I think the biggest driver has been the commercial activity across the board. I think all of our divisions are doing well. But I think what really stands out is the performance of our customer base. Really, they are getting much more active in terms of their payments, their activities, and also their credit profiles are improving significantly. And that has resulted to a degree in low risk costs, indeed negative risk costs for this quarter for ING. And I think we have a big boost in terms of fee income, growing by almost 18%.
I mean, speaking of a big boost, you're planning to distribute 3.62 billion euros to shareholders after September 30th. What does the path of payouts look like? Do you see continued growth when it comes to returning capital to shareholders?
Yes, what we announced today is really two tranches. We're paying a 48 cents per share dividend, which represents roughly 1.8 billion euros. And we're in the process of getting the necessary approval for either a further cash dividend or a share buyback. So that is all coming in the next period.
Okay, so what has your communication been like, assuming that part of this has to do with the ECB and what's approved on that end? What has your conversation been with policymakers when it comes to the moves to pay out dividends and buybacks?
I think the conversation has been constructive. We fully understand why the dividend ban was in place up until recently because of the uncertainty around COVID. Given the strength of the banking sector, the resilience of our customer base, I think it's a good time to return to business as usual and normal capital returns to the shareholders of banks. And that's what we see today, is more of a resumption of normal business, normal dividend policy, and that's good news for all stakeholders.
Right, and your loan loss provisions also coming in significantly less than had been expected on the street, 91 million euros, the estimate 282 million euros as well. And of course, as I'm saying this, the headlines are just coming in. So in terms of getting back to normal, from getting away from this place where COVID really impacts earnings, of course, the rise of the Delta variant is something that's been troubling a lot of executives. How does that impact your outlook?
Dani, we remain conservative in terms of our stance with respect to loan loss provisioning. But having said that, the macro picture looks a lot better than it did 12 months ago. The performance in terms of non-performing loan looks better than it did 12 months ago. And quite frankly, a lot of our customer base are really coming out of COVID in very strong financial positions and deleveraging, getting very financially healthy. So I think while we remain cautious, the reality of our corporate lending book is reflected in our risk cost, which is low for this quarter.
So looking out into the future as well, not just when it comes to COVID, but what about inflation? This is something that's been vexing, regardless of what industry you're in, many corporations. And of course, this is important to ING given net income. Where do you see inflation going? Is it moving higher? And how long lasting will that be?
I think our view is that the high top-line inflation for the next couple of quarters will not last, and that inflation will gravitate more towards the targeted 2% by the ECB. Having said that, I think we're preparing for at least operating in negative interest rate in the Eurozone for quite some time, and that as ING, we are busy, of course, taking steps to make sure that we can operate profitably in negative interest rate environment.
How much of that has to do with cost cuts? You've closed some offices, France, for example, Czech Republic. What specifically else are you looking at in terms of those efforts?
I think our cost programs are across the board. We are obviously seeing significant digitizations by our customer base, and that has meant that we are reducing our branch footprint to fit with what our customer demands are. So reductions in branches, digitizations of our internal processes, and also indeed looking at certain geographies which we deem to be subscale. So we are exiting from some of those markets as well. But I think the biggest driver of our digitization is really the sheer usage of, for example, mobile channels by our customer. Now more than 47% of our customers actually only contact us through their mobile device. This is an incredible, lasting structural change from the COVID situation.
Tanate, what does the hunt for talent look right now? For example, are you considering rising wages, or have you had higher wages in order to attract more people into the firm?
Yeah, so I think, speaking for myself, I think ING is a fun place to work. I think it's a place where it gives a lot of, balance in terms of work-life balance. We pay competitively. And these combination of factors means that we are ranked as one of the best places to work within our markets. And I think we are quite pleased at attracting talent as ING.